the stock has been significantly cheap for a while. I mean, the valuation 11.8, ex cash 8.8, that sometimes gives you a clue on what investors need. And they need a must-have. They need something they can grab onto. Apple's a good and great company. The outlook is wonderful. Services is very strong. They have some good things down the pipeline. But right now, there has to be a must-have in their hands, and there is no must-have. And I think even with iPhone 7, there's nothing to it right now that we know of that makes people really want to own the stock. And so, yeah, long-term, great stock. But right now, people need something here and now.
It's a difficult situation for Apple, isn't it? I mean, we're spoken so much about expectations being the key driver of the returns that we've seen in this reporting season, in particular low expectations. But when it's Apple, it's the opposite. People have such high expectations of them.
Yes.
Even if they're getting the lion's share of all the profits that are made on smartphones, people get concerned that they're not going to be able to sustain it. What do you think they need to do to assuage the market? What do they need to announce come September in order to get that momentum, that X factor back?
Well, I think they need to have something with iPhone 7 that would be a must-have, and I don't think that's going to happen. Beyond that, I think they need to demonstrate that they're just blowing the doors off in China with regards to sales, which they're doing a very good job. But to your point, the bar is set very high for that company, and it could be one of those situations where the stock could remain cheap, really cheap for a long time, because the bar is set high, even though fundamentally and long-term it's a very good stock to own.
Absolutely. We've had some other tech stocks coming out this morning as well. I don't know how much time you've had to look at them, but eBay coming out, Twitter's come out, AT&T's come out. It looks like Twitter in particular is being punished. It's hard to see where the momentum's going to come, isn't it? The tech stocks, even the ones that are doing okay, are not shooting the lights out. Do you think overall the tech sector is going to go down? It's a bit disappointing in this reporting season?
I do, and only based on the fact that software is doing well. It seems like software companies in aggregate are doing well. The big names, not so much, and then you have the internets doing poorly. That said, if you look at it in aggregate, it's okay, but people expect more than okay, especially given the V-shaped recovery we've had over the last few months. Okay is not good enough, and so I think it's going to be a drag anchor on the rest of the market for the short term.
Absolutely. We were waiting on Apple. There's a big lead up to it. We've now got the numbers, so now we need to look forward. What are we going to see for the rest of the week that might turn us around? Obviously, the FOMC is there as an issue, the Bank of Japan, but in the corporate news, is it Boeing going to be one of the big ones to turn this around? Is it Exxon coming out on Friday? What do you think is going to build momentum either to the upside or the downside?
Well, I think it's going to have to be the FOMC beginning tomorrow. I mean, a lot of that basically is about balanced outlook on things, the perspective of the FOMC. It's hard for me to imagine for Janet Yellen to do anything that's going to upset the market or be necessarily hawkish tomorrow, although I do believe she will raise rates perhaps in July now as opposed to June. But I think that's going to be the game changer. Like right now, you look at the U.S. dollar, or especially 10-year yields, they're building in a little bit more hawkishness than maybe the market was accustomed to. So that, combined with the rest of the earnings season, earnings has definitely done better than most people have expected. If you look at all of them, I mean, you figure earnings per share have beaten by 4% on 80% of the stocks. Revenues have increased about 40% of the stock, so it's been better than expected, and that is true. The bar has been low, but the fact remains that we've gone from $117 earnings per share in the S&P 500 to about $123. So it's been pretty stellar. It's enough to keep the market from crashing, as it were.
The US dollar has been interesting in trade during your session, down to a 10-month low. That does seem to suggest that some hawkishness is being built in. Do you think that's being overplayed, though? Why do you think that people are betting on this now that the FOMC is actually at least in meeting form? Is there things leaking out? What are we hearing on the street that making people maybe change their expectations of when we can expect a rate hike?
Yeah, you know, it sounds overly simplistic, but I think this is really the bottom line, is that the U.S. dollar had a valuation problem on the way up. It never deserved to be as high as it was last year. And now it's just, you're seeing a lot of weak hands just, you know, change their position or reverse their position or lighten their position. And do I think the dollar has bottomed out? Personally, I do. From a trading standpoint, I do think it's been overdone. But I think that's just a reaction to how this market has been with currencies. And we know that when it comes to momentum in the market, it's impossible to predict the movement of a currency. It seems like it always moves further and faster and for longer than most of us expect.
I want to get your take on this, Larry. One of the hallmarks of our reporting season last time around was the overreaction, it would seem, by market participants, by investors on results. If someone beat by a little bit, you'd see the stock price spike, and if they missed by a little bit, you'd see it plummet. What has been the hallmark, do you think, of the US session? Have people been overreacting to results? I mean, I'm looking at Apple's now extending those losses now down over 5%, also hitting, obviously, those suppliers. Bell Skyworks down 3%, Corvo down 2%. What has been the hallmark? Do we look jittery? Do investors look jittery in the US at the moment?
I don't think so. I think really it's this whole dynamic of positioning that we've seen in the market for the last couple of years. I mean, there's a group of hedge funds, you have large trading organizations that really are almost looking beyond fundamentals. They almost don't care about earnings or the valuations of a company, and really looking more about momentum and positioning of the stock market. That seems to be driving everybody. And combined with the fact that you have the vast majority of mutual fund managers in the equity space here underperforming the market by a huge margin. So you're going to see a lot more active management and micromanagement more than you should expect. But I think that's the bottom line. It's been going on for a long time, that it's not fundamentals, it's more about positioning.
We were speaking to an analyst earlier in today's session. They suggested maybe Buffalo Wings and Panera Bread would be a good read on momentum, a good read on whether or not we're going to see an optimistic start tomorrow. Buffalo Wings, I'm looking at now, down 12.7% in extended trade after their Q1 outlook. Is it because it looks like maybe the economy isn't doing great? Does it look like the US consumer maybe isn't out there spending money? And does that potentially change the calculation for the FOMC?
Yeah, I do think so. I mean, I think for one thing, it's absolutely perplexing that we haven't seen more benefit from the consumer, the tailwind of the lower gasoline price. Now, clearly we've seen it. It's just not where we normally see it. Service sector has done better, but when it comes to the consumer, the hardcore restaurants and department stores have not seen that tailwind. And I think people just get skittish. I mean, the overall economics in the U.S. in the last 6 months have been stagnant, to say the least. And so people, you know, after a while just get very skittish and like, well, why do I own these stocks if economic data is not getting better? Will that affect the FOMC? I would like to say it won't, because I still, my major premise with this, that we have to remember that this zero rate was all due to be an emergency measure. It wasn't meant to be a long-term situation. So even if things aren't great, I think at some point they're going to continue to raise rates.